if you look at what is the most common or well-known type of strategy in the market today, or what is one thing that almost every single trader understands, is support and resistance. And that's because, systems that involve an EA tend to use support and resistance. Systems that trade chart patterns are support and resistance based. Obviously, many different types of support and resistance strategies in general. Many strategies that use indicators use support and resistance to trail stops or to set stops. So it's just a very common method. It's something that's well known to everybody, and that's why that's one of the first places that we begin to look as a potential high probability point. So why I chose that deeper level in the review was pretty straightforward. I'll get rid of this here so we can see a little better. But as you look back, this was a point that essentially saw the most response. We saw a lot of stop runs of this level in the past. Anytime it broke it, it was always getting rejected right back down below it. Again, a nice set of reverse legs at that point. Very clear response back through here, and you can even go back further and you can see that there was even more of a response. So it was pretty well a no-brainer for me to choose that level in the review. So going into it, initially we came into this, we saw a nice stop run candle at that level. The following candle gave a decent confirming candle up, closed, basically right on its 2/3 point, which is a good indication of whether that's a good confirming candle or not. The basis of the current confirming candle is that it's closing above the body of your stop run candle. If you're closing above it by a pip and you have a huge wick to the upside, well, we have to use some common sense. So again, preferably is closing as close to its highs as possible. Not a bad confirming candle, and thus why I took it. So anybody else that was taking this, if you were taking it right around basically the only pullback that we had, you still got a fairly good entry. We were only about 13 pips away from the lows, and that was why I was taking that trade. What I mentioned last night in the review, and the reason for the exit on this trade, was that we came into the second manipulation point we had, which was right around 82, 83. And we saw a stop run at that level. So again, there's only three reasons to exit a trade. Number one, it's hit your limit or your stop. Number two, you're coming into a session change, meaning if you took a trade during London, you're coming in at 8 a.m. and the trade's at or near break even. You want to be closing that trade. If you have a little bit of leeway, it's possible to move it to break even. But either way, you want to be protecting yourself in some way, shape, or form. That's the second reason. And the third reason to exit trade would be a stop run against the direction that you're in. So when we came back up here and we saw a stop run of that level, that was what got me out of that trade, and why I ended up taking a 2-pip loss on that trade overall. How did I know we had a few traders that took this euro. How did you guys do on that one overall? For anybody that wasn't in the room, we had a pretty nice setup here with a stop run of our high probability point. It was a little bit skewed because the confirming candle came right at 8, but I know that a few people took it, so I was just wondering how you guys did on that one. Really, you didn't have much downside, and as long as we're hitting that 2-to-1, that's the key. That's the repeatable part of it. If you're, in this situation, yes, you'd like to have seen a bit more, but again, we trade the averages. We trade the fact that the market doesn't tend to run. It doesn't tend to run 200 pips in a day, or doesn't tend to go outside of its average. So what we do is look for the base or the heart of that move, and that 40 to 60 pip area is a good point to look for that move. The market will readily give up 40 pips, but it's much more difficult, exponentially more difficult, to get 80, 100 pips. It's not like it's just twice as difficult. There seems to be an exponential increase with the increase in take profit, and you know that's just the way it is. That's why we want to capture the main part of that move and not try to catch the move from extremity to extremity, because plain and simple, you're not going to do it with any consistency. All right, so anyways, we'll address where these are at in the daily market review tonight. Even though we've only ran 2 cycles on the euro, you know, it's possible, as I mentioned in the daily market review last night, as we look at the pound here real quick, I'll go out to the hourly chart of the pound. And we had our first push, second, and you could definitely differentiate a third within that. You look at the criteria that makes up a weekly cycle. Nowadays, if the market's running 200 pips over the, as a overall push, meaning the 3 cycles encompass about 200 pips, maybe a little bit more nowadays. That's one base rule that we look for. So is that rule satisfied here with the pound? Well, we've gone 360, so that's definitely satisfied. Second point, has it happened over the course of, generally tends to be around 3 days, give or take a bit? Well, we're on about 2.5, so the cycle is a bit short, but is definitely blown out the first point, and we very clearly have 3 separate pushes all over 90 pips. So a lot of the criteria has been satisfied, and that's why, you know, for example, tonight, if the pound did come down and create a stop run on its lows, more than likely I can already tell you what I'm going to say in the review tonight, and that is, if it does come down and create a stop run on its lows, I will look to take that long, more than likely. So we'll have to wait and see. Obviously, I want to see the rest of this day. That could change, but you know, we'll see how that progresses. The euro, I'm really going to need to see the close, just because there are a few questions on it, so we'll wait for the close to really solidify that. And obviously talk about that in the review tonight. So anyways, one of the things that the main purpose of the room, or one of the big points of the room, is the fact that we can, or you guys can ask questions, and Chad and I can answer it live in real time, and it tends to, you know, you just tend to be able to answer questions better over voice than you do, you know, through text. So we'll start fielding some questions as far as what you guys have. Have you taken any trades lately? Good, bad, ugly? What have you done? I know we talked about some of the last setups that came together. The big issue with the euro is number one, are we at a high probability point? If we're not at a high probability point, I won't even look for a level to create the manipulation at that point. And as we go back, you can see that we've really gone through the best level that we had, and we're into a situation where what I term is no man's land, meaning we haven't seen a lot of response in this level. If you look back as the market came up through this point, there just wasn't a lot of response at that level. So that's what makes taking a trade on the euro a difficult trade to take, because you don't have a great level to trade from. An M or a W, that you got to understand that a M or W bottoming or topping formation is a nice way of saying that's a double top or a double bottom, or a nice way of saying it's a 1, 2, 3 ABC reversal. The only time candle patterns or chart patterns mean anything to us is when they're at a high probability point. So in the situation that the euro's in, when I look back, are we at a potential level where I would expect stops to be? The answer to that question is no. I mean, obviously, anytime you bounce off a level, meaning the market has obviously turned from a low here, you can expect anybody that is trading short term, where would they put their stops? Well, this is a larger than average push that we've had, so you know, we're about 40, 45 pips away from the lows. So do you really believe the stops are below that point? Well, I think that's probably the best point that we have as far as as far as what we're dealing with now, but because we haven't had any response in the past to that level, I do question that. And if there's not a high probability point, then we shouldn't even be looking to trade off that level. Okay, Blake, that's a good question. We'll go over. Blake's question was, why does a level 1 fail? That's a really good question. We can go over that. What moving averages are you using, and how do they come into play, if at all, in your trading? The moving averages are the 200 EMA and the 60 EMA. Essentially, and I'll break down what a high probability point is a bit more here, but they act as confluence. In other words, I don't use them single-handedly to trade from, but when they coincide with levels I'm already expecting to be high probability points for the orders to be around, when they coincide with that, it's just an added level of confidence in that level. I watch the S&P 500 and the Dow as a correlation, as well as the dollar index. However, one of the things that Chad and I do, and this also is the same thing for why there's nothing in the course as of right now, which I think Chad's actually in the first update to our course we've done in a year and a half or so. One of the things that Chad is going to add in is a very simple explanation of how volume can be used as, again, just not as anything different than what we're already doing, but just as an added filter. So it's kind of along those lines. It can be used as a filter because there is a correlation between equities and in the Forex market. But one of the things that, again, we try to do is keep things down to the very basics that are going to be needed to make somebody successful. We've had a really good track record of taking traders that are either new to this market or have failed for years and giving them a good chance at success. And I think a lot of the reason that we have a good track record of helping traders is that we try to keep things as simple as possible. So correlation is one of those things that maybe down the road I'll teach as more of an advanced thing, but the reason I avoid it is because I feel like without a real proper understanding of it, it can be more confusing than anything else. The blue moving average is a 200 EMA. All right, Miles asked, I asked this in email and you answered it. I asked, why does the market tend to work in 3 cycles? I appreciate it's not planned by the banks or anyone else, but I just wonder why it happens to be, and why is it 4 or 8? Just trying to get a concept. The answer to that question is because after 3 cycles, there's a psychological change where the market, people tend to feel like it has to reverse before continuing, and that psychological effect, and seeing cycles or waves of 3, is just how the market turns. It's something that has spanned all markets. It's something that has spanned time and has been around longer, again, than any of us have been alive. And the fact that the market tends to cycle in waves of 3 is not something, like I wrote in that email, is not something where the banks are sitting there saying, okay, we've made a second push, we have to make a third. It's just a fact that the market tends to cycle in that fashion. So again, the market is made up of humans, made up of those that are placing their orders in the market. When 3 cycles are established, there tends to be a psychological change, which goes from a bias to continuation, from continuation to reversal. As far as some extremely in-depth explanation, I don't think there is much of an explanation beyond that. There's different theories as to why it does, but at the end of the day, it comes down to the fact that there is a perception shift after 3 cycles, and that just tends to be the way it is. I also had an email. Somebody asked me, they were using MB, and they asked me what charts I use. These charts you see here are El Pari US. If you use MB trading like I do, and you use the navigator, you do not have charts. It's very simple to go get charts, guys. And I hear a lot of people complaining about MB trading because, you know, number one, if you want MT4 charts, use their MT4 platform. But if you want to use the navigator platform like I do, and this is just a question while I'm thinking about it, the simple thing to do is go open a demo anywhere and just use the demo charts to trade from. I've done that for the last, 3 or 4 years as I've used MB, and it's just the way I do it personally. It's just an option, and I had 2 emails in the last couple of days about that, so I wanted to address that. The reason I use these charts is because they remain stable, and you don't see any huge spikes to one side or the other that screw up the perception. I guess perception is the right word. That screw up the scale of the market. If you guys have ever seen those large spikes, they screw up the whole scale of the market and the scale of the chart. So that's why I use those charts. You could open charts anywhere you want. The bottom line is you're just looking for charts if you're trading through them. I'm going to get to that question about why there's a failed first push. We'll discuss that in a minute, but I'm going over some other questions before we get to that. That'll take a little while to explain. Yeah, I can go over Chad's short. I think he took and Chad is a little bit different trader than I. There's very rare where you see me ever take over 60 pips on a trade. And more often than not, it's me taking 40 pips on a trade. Chad, on the other hand, is a bit different trader. He'll probably take more break-even trades than I do because he does hold out for a bit more. But in situations like yesterday, it definitely pays off. Okay, we'll cover that too. How can you tell if there's no? Just run down. Well, Mike, number one, what I would say is what type of success have you had with trading breakouts? And that's a question only you can answer. So you have to look at your breakout trades over the course of 3 to 6 months. A week worth of profitable breakout trading or a month worth of profitable breakout trading is not a good showing. What has it done over the course of 6 months, 9 months, a year? So that's a question you have to ask yourself, number one. Number two, with breakouts are the classic trap of smart money. The breakout trader and the whole belief of the break above or below the Asian session is a classic trap that is set by smart money. It's what we discuss in the daily market reviews every day. It's why we identify the high probability points, and quite often the levels that we pick for high probability manipulation points are breakout levels. And the reason being is breakout traders are the fuel of smart money, or they are part of the fuel of smart money. And there's a myth that trading breakouts is a profitable strategy, and I'm always open to being proved wrong, and I say a lot of things that are my opinion, so don't necessarily take it as me saying no matter what, it's not. But one thing I do know is that traders very rarely maintain a high risk reward. Because of that, they don't do well with trading breakouts. Trading breakouts probably could be a successful strategy if somebody maintained a positive risk reward. But generally they don't, and because a strategy like that would be necessary, that's why people tend to fail with it. Why we look at breakouts from the opposite perspective. We look at it from the perspective of, okay, hey, there's going to be orders in and around this level, so we should trade the stop run or the manipulation at this point. Okay, let me go over a couple questions before I miss them here. The first one was why does the first push fail? And this is a really good question. If you guys, for anybody that is a member, and I even mentioned this in the review last night, you can go back over the course section of this for a bit more information. But the gist of it is that when you look at a cycle that is complete, so we'll go to the hourly chart real quick. And we had a first push down, second push down, we had our third push down. We entered into the sideways accumulation, very typical at the end of a cycle, seeing a sideways accumulating market. So one way to view the false push, and I guess I'll lay the groundwork here. Our belief is that there is no arbitrary move in this market. This is a $4 trillion a day market. It takes gigantic amounts of money to move this market. We also know that there's 10 banks that control 75 to 78% of the daily volume. Now think about that. I don't care whether you have $1,000, $5 million, or $10 trillion. 70% is 70%. If you control 70% of any amount, you will dictate where that, essentially where that market goes. If you control 70% of any market, you will dictate where that market goes, period. There is no ifs, ands, or buts about it. That is a fact that nobody can dispute. So because of that, that's why we say there's no random move in this market. There's no move that does not serve a purpose, because there is a very small group that is in control of the market. So because there's no arbitrary moves in this market, we have to ask ourselves, why do they repeatedly, if they're going to continue, if they're going to go 1, 2, 3 down, 1, 2, 3 down, 1, 2, 3 down, why is there almost always one push against the previous cycle before it continues? So in other words, 1, 2, 3 down, and let's say we've had 1, 2, and our third push to the downside. If they're going to continue the price down, more than likely, we'll see a period of accumulation or sideways range-bound market, and we will see one false push up before the continuation down. That is the way it tends to work. Obviously, there is no absolute in this market with anything. There's no absolutes in any market. So there's probabilities. Now that is the probability of how they tend to continue a trend. If they're going to continue a trend, they tend to create one false push against the previous move before continuing the price. So the question is, why do they do that? And if we know there's no arbitrary move in this market, then what is the purpose of that move? So it's really a twofold purpose. And which of the purposes it's really satisfying on each move really doesn't matter. The point is that we know it's a twofold purpose. Number one, it's the move up is started by them closing out a previous position. As they begin to close out that position, the market begins to rise. As the market begins to rise, you have those that are piling on. You also have those that were anybody else that is closing out a profitable short position, they have to buy that position back. As the market fuels to the upside, and this goes with any move, as the market either goes up or down, you have those that are jumping on the bandwagon. Number one, the indicators are starting to roll over, showing the move up. Traders that are trading the breakout are starting to pile on. All the thousands of different strategies begin to pile on. And this is really at the heart of everything that we do. If you think about, and this point I'm about to make is probably one of the most important things you can take away from this room and give serious thought to. Any strategy you've ever used, and maybe there's some exceptions out there, but as a general rule of thumb, which will encompass 95 to 98% of all strategies, what is required for them to eventually trigger along? In order for any strategy to eventually trigger along, it requires the market to begin to work its way up. As it begins to work its way up, the different software start to trigger, different indicators start to trigger an entry, breakout traders start to trigger. Whatever type of trader it is, in order for a long to be triggered, the market has to begin to work its way up. That is a simple fact that is at the heart of most strategies, and it's the same way for a short. In order for a short to be triggered, all mainstream strategies rely on the market beginning to go down to eventually trigger a short. You don't see strategies that trigger a long as the market's, or trigger a short as the market's going up, and conversely, you don't see strategies that trigger a short. They don't trigger a short as the market's going up, and you don't see strategies that trigger a long as the market's going down. It's the opposite way. So if you think about it, and you look at it from smart money's perspective, or if you look at it from the bank's perspective, those that truly have to move a massive amount of volume in order to enter the market, how do they enter trades? Because really, it's not how the average retail trader does it that's important to us. It should be, how does that 70%, or how do those 10 banks that control 70% of this market, how do they enter a position? And we have to go to a basic formulation for how this market and all other markets work. For every buyer, there's a seller, and for every seller, there is a buyer. When you control so much of the market's volume, as they do, again, 10 banks controlling 70% of that volume, when you control so much of that volume, you have to induce buying pressure in order to sell into the buying pressure. Conversely, you have to induce selling pressure if you want to buy into the market. Without sellers, you can't buy, and without buyers, you can't sell. For us, that means absolutely nothing, because we will never have the issue of liquidity. There will always be somebody willing to take the other side of the trade, whether it's the broker or whether it's somebody else in a live market, depending on who we trade through. For the banks, that is not the same. They have a daily struggle for liquidity, and that is why it goes to another good question is somebody basically said, you guys really need to shut up because you're going to screw this up for all of us. And that was kind of a funny joke, but we hear that a lot. And the fact is, it's not possible for it to be screwed up. The banks have to induce buying pressure in order to sell into that buying pressure. And they have to induce selling pressure vice versa. Yeah, obviously you guys know what I'm saying. I just tangled myself up there. You get my point as far as they're selling into buying pressure and buying into selling pressure. So anyways, to say that 10 times over, but that's the basic gist, and that is probably one of the more important parts. So again, why is that important? Well, we just discussed that retail strategies do the exact opposite. In order to trigger a long, retail strategies have to begin to see the market rolling up. To trigger a short, they have to see the market rolling down, and is again exactly the opposite from the banking's perspective. You go out to the daily chart on the pound, and you ask yourself, this is a very good question. Why do they break above the high? Why do you see a stop run above the high to start that move? Why do you go back and you look at equities and you look at the original crash of equities back in 2008, 2009? Why did they start to break a new high right before the market crashed? Back about a year ago, before the market started to turn up from about, I believe, 10,000, why did it break a fresh low before beginning to turn up? Again, that's because smart money does the exact opposite of what the average retail trader is taught to do, because they have that search for liquidity. So that goes into the false push. It goes into why they create this false push. Essentially, as they close out the previous short position, that begins to fuel the market up. As the rest of the market piles on, they are creating outside buying pressure. At some point, they begin to sell into that outside buying pressure, and that is the purpose of the false push. By starting that move, it creates outside buying pressure. As that outside buying pressure comes in, they begin to sell into that buying pressure. So it's essentially creating liquidity for themselves. You know, there's a reason that as you go back and you know, you look through, you know, you go back, you look through this market and you look at you look at what tends to start a lot of moves. And one of the things, as we were going through this level 3 type accumulation, one of the things that was very visible is the manipulation in a range, which manipulation in a range tends to be very visible. Why do they break a fresh low before turning back to the upside? As you start to scroll over a bit more, I'll let that chart catch up. Why do they break above the previous day's high before turning the market back down? You know, even at these lows, why do they break below the Asian lows before pushing the market up? And you could go forward all day long. This is the long trade that a few were taking on the euro. Why did they break below the lows before turning the market to the upside? The reason that you have this, and this is a very basic overview of it, but the reason that you have the market breaking lows when they want to turn it up and breaking highs when they want to turn it down is very simple. It's the daily search for liquidity. That will never change. It's always been that way. It will always be that way. Go look at the daily chart of the Dow. Look at most of its major swings, and you will see it break a fresh low before it turns up or break a fresh high before it turns down. That's a daily chart. You can zoom it down to a 15-minute, which is what we do, and you can trade the manipulation on a much smaller basis because it happens every single day. So that's the basis of the false push. It's why they create the false push, and it's why it's why after seeing that false push, it's why last night we were looking for the push down, because it's very simple. If they had, obviously they were selling into any buying pressure through here because the ensuing day's price action proved it. So because of that, we can almost be certain that the next day we're going to be working to the downside because of that false push. We have a very high probability of it. What smart money does, and this is really the great part, what they do the day before means something to us the following day. Because these cycles tend to be over the course of 3 or 4 days, when we see essentially what is a giant stop run, which is what the false push is, that gives us our direction for the next couple days. So it's a very, it's a very useful tool once you begin to look at the market from their perspective. But again, and really give this some serious thought, if you look at all mainstream strategies, they rely on the market going up to trigger a buy and going down to trigger a sell at some level. Every one of them will trigger at a different point, but you guys get the gist of what I'm saying. And if you look at it from the bank's perspective, it is exactly opposite to that. As the market begins to move up here, they were not buying into an already rising market. They began to sell into a market that was pushing to the upside. And that's a powerful point. Once you begin to look at it from a different perspective, number one, you start to realize how most strategies put you against the banks, which is a very dangerous position to be. So you start to realize that, which is extremely powerful point. But just as powerful, you realize how you can use this to your advantage, and you start to realize how this is information that you can trade with on a daily basis. All right, let me scroll down and see what other questions I missed here. Would you say 32.40, 32.50 on the euro would be a high probability point? Let me go back and look at this. 32, 32, 40 to 50. Let me just throw a line there so I can see. Well, if my memory serves me, on the euro on the daily, this was a level that had a lot of response to it. And yeah, I'm looking back at it. This was actually was a longer term point that was really good. I know the chart's screwed up. I'll give it a second to catch up here in a minute. Yeah, I would say more or less about the 56 area or so. Maybe even a little bit higher, probably about 60. Yeah, about 67 actually. That was the point that I was kind of hoping it was going to hold on. Notice all the tests of this level on the 4-hour chart. So if you and I can say, hey, this is a level that has had a heck of a lot of response in the past, because we know support and resistance is one of the most prolific strategies out there, if not the most understood strategy and well used, that's not an opinion, that's a fact. So if we can identify a clearly visible high probability point, and then we see the manipulation at that point, or we see the stop run of that level, that's a huge piece of information that we can use. So that's kind of why I was hoping, at least, for the 3267 level to hold. But obviously, we broke that through the Asian session. So that threw that out the window. All right, let me keep scrolling here. Glenn, the blocks on my chart, and this is really I've kind of fallen in love with these blocks, but one of our members a long time ago made us an indicator, and well, Chad used it long ago, but I never used anything on my charts because, quite frankly, I like as little as possible on my charts. But one of the reasons that I still have it on there is that it shows you where you're at in the day. So I can sit here and I can scroll back and I can say, okay, New York session, Asia session, New York, Asia, New York, Asia, and I know exactly where I'm at in the day. But that's why I leave it on my charts. But they block out, the big block is the Asian session, and that goes from, or that ends at least on my charts, ends at 2 a.m. Eastern. And that's really when we begin to look for trades, 2 a.m. to about 5 or 6. And the smaller, wider gray box is the New York session, and that goes from 8 to 11 a.m. Good question. Question was, how do you set your stops? Well, let's go to a real-life example, and I'll show you how I set my stops. So again, when we talk about the fact that breakout trading is dangerous, why do I say that? Well, I say that because it's a level that's clearly identifiable to everybody else. More than likely, you're going to have orders sitting in and around a breakout point, and therefore it becomes like a shark to meat, essentially. If you have orders sitting there, somebody's going to go take them. So one of the most dangerous locations you can put your stop is above a high or below a low. The reason that that's a dangerous position is because everybody else is doing that. So because of that, that level becomes a prime target for the banks to create the false push of the stop run on that level, take the stops and reverse the price. So that's why any breakout trader at this point on this trade got screwed on that position, and the reason behind that was the fact that they triggered all the breakout orders or the stop loss for anybody that was long, and then immediately turned the price. So where we want to trade is after we see the stop run. But where I put my stop, number one, I'm not taking a trade unless I can use a 20 pip stop. That's number one, very important point, because if you're not maintaining the positive risk reward of 2 to 1 or better, or I mean a little less than 2 to 1 is fine, but you want to be right around 2 to 1 at least. And the reason behind that is, in all the traders I know that are successful, and all the traders that in this room or in the members that are doing well, they maintain a positive risk reward. one of the traders that actually I just did a testimonial video with, which was, quite frankly, probably it was a very good representation of what we believe, and that is the fact that risk reward is single-handedly one of the most important parts, I would say. But the gist of what I'm getting at in relation to a stop is that this specific trader, he actually, his win-loss ratio had been less than 50%, but he'd been averaging, a couple hundred pips a month at least, and it's because of the risk reward behind it. Risk reward is sustainable. A high win-loss ratio of 80% is not sustainable. A win-loss ratio between 50 and 60% with a 2-to-1 risk reward is much more sustainable. And again, I'm mentioning it to, hopefully we're above that point, but I'm drawing an article I wrote does this a bit better, but it just really drives home the point of the fact that risk reward is so important. Okay, so anyways, in relation to the stop zone, why I was talking about that, maintaining that risk reward, that's why I use use a 20 pip stop. But where I place my stops is beyond the stop run high or beyond the stop run low. So in other words, unless that high or low was a stop run or the manipulation was seen there, I don't want to have my stop there. So in other words, when this proved itself as a stop run, meaning it came down, took out the stops, got rejected back up above it, that's when it became safe for me to put my stop below that point. So the simple answer to that is above the stop run high or below the stop run low. If it's just an average overall high or overall low, then that is, again, probably the most dangerous place to put your stop, which is where most traders do put their stop. But once the stop run is seen at that level, then the stop run can be placed, or the stop loss can be placed above that stop run or below the stop run. Randy asks, can you time an entry around the open or close? I see that when a candle just before it closes bullish or bearish, the candle will pull back. I'm not really sure of your question there, Randy. Let me read it one more time. Hang on. Oh, okay, I get your point. I mean, I'm sure somebody could mess with that and maybe find a probability in there, but for me personally, as far as timing entries based on an open or close, I've never done anything like that just because I don't see the probability there. Manipulation happens in crude oil as well, John. I mean, the fact that a small portion of people control well over 50% of the volume, that means there's always going to be a struggle for liquidity. It's seen in equities, it's seen in metals, it's seen in commodities across the board. What I always recommend when somebody deviates from the Forex market because cycle becomes less apparent is to trade manipulation at high probability points only without much regard for where you're at in the cycle. Brian says there's many books available about the psychology of trading. That's true. There's not many books that I recommend. Market Wizards is a good one. The Law of Success is a good one. It really doesn't have to do with trading, but that's a great book for just being successful in general. There's a few other ones. I'm drawing a blank here, but there's definitely some good books in regard to the psychology of trading. Andy asks, is the 3-cycle move similar to Elliott Wave? Well, Elliott Wave has a lot of rules in and around it. The fact that the market tends to cycle in 3 waves to one side or the other was around long before Elliott Wave was around. So you could put whatever name you want on it. Do we follow the same rules and principles of Elliott Wave? No, we don't. But the belief that the market cycles in three pushes to one side or the other is something that's been around for since the dawn of markets. Mike, so why not take a breakout trade of Asia to the manipulation area? Because that generally there's not enough room to take a 2-to-1 risk-reward opportunity. So one of the biggest things I see traders struggle with is the feeling or the thought that they have to catch every trade. If you have to catch every move, every trade, you're going to end up losing money. The ones that succeed are the ones that have a very, very specific idea of exactly what they want, and they only trade that. So there are a lot of moves that we miss. But you know what? As far as when it comes to the success of our members and seeing how many of them are doing well, to me it just instills every single day that the more specific you are, the higher the chance you have of creating a profitable trader. And that's really our goal. Our goal is to create profitable traders. And while, you know, by no means will everybody that joins us be a profitable trader. And I've said this from the get-go. It's plain and simple. It's the honest answer. And the fact is, we can't control a lot of things. We can't control things such as, you know, the belief in, there's a lot of deep-seated beliefs in traders, and this kind of goes back to that breakout question. But it's a good question that you bring up. But there's a lot of deep-seated beliefs, and these deep-seated beliefs are backed by zero track record of profitable trading. But yet these traders are such staunch believers in whatever it is that they believe in, EAs, indicators, you know, chart patterns, breakout trading, whatever it is. They are absolutely staunch, die-hard for this, and they have absolutely zero track record to back it up, and it just baffles my mind all the time. And breakout trading is one of those things that I know it's very common to people, and people are, again, extremely strong beliefs behind it, but they have no track record to back up their strong beliefs. And so my question is always, why? You know, that's my question, is why have that strong belief? And so that's what I really try and get traders to steer away from, the idea that, number one, you're going to try and optimize and catch every trade. It's just not going to happen. You know, so what we want to do is we want to catch the cream of the crop. And the trades that are going to give us the highest probability of a successful move are trades in the direction of the cycle at a high probability point when the manipulation is seen. You know, very simply, we ask ourselves two questions every day. We ask ourselves, where are we at in the overall cycle? Where are the high probability levels? Then we wait for the manipulation to be shown at those levels. Really, what we do is extremely simple. It's just a matter of, you know, it's a matter of putting it to practice and putting it to use. No, I don't use COT data or COD data, Boyan, as far as commitment of traders is concerned. I think it's too delayed to make use of it, and I haven't found any edge through using it. Sam, it depends. Your question, do you count a dramatic move in a direction as a smart money move, even if it was fueled by a news release? Well, who's fueling that move? Even if it was every retail trader moving the market in one direction or the other, we don't have enough money to sustain that move. Number one, because most of our orders never even go to the live market. But number two, the fact that we just don't have the money to push it. So there's a reason why, and if you go back and you look at major news announcements, when the market has ran a great deal coming into the news, they will use the news to create the stop run and reverse the price. Conversely, if the market, let's say, is moving down and you get a trade, you get a spike against the move to the downside, so it spikes up, a lot of times they will spike it past a high, take out the stops, and reverse the price immediately. News often creates a very good opportunity for us to place a trade if you understand how to trade manipulation. Tim, asking, do the banks all act in unison, essentially? The answer to that question is no. Very simply, and we teach this market from and I've said this many times before, but for those of you that are in the room for the first time, we teach what we do from a very simple perspective, meaning we teach it us versus them. Common sense should tell you there's many facets to the market beyond what we teach, meaning there's different levels. There's your top 10 banks that control the mass of it. There's different trading institutions, hedge funds, floor traders that are creating liquidity, high volume computers, and then your average, brokers that are hedging their position in live market. So you have many, many different facets. And one bank may be benefiting or trading in a different direction, or as far as their longer term or shorter term goals. And so there's many different facets to it, and that's why what we try to do is we try to keep it as simple as possible. We understand the market tends to cycle in three ways, one side or the other. So that's the first question we ask ourselves: where are we at in the cycle? Number two, where are our high probability points? Very simply, from that point, we wait for the market to show us some manipulation at one of those points, and that's where a trade is taken. So when we think about who's making the move, are they all in unison, or all the other 50 questions that that somebody could wonder about, there's many things that we will never have the answer to. And so it really doesn't matter who's creating that manipulation, who's, what their overall goal is. The point is, it happens in every market. It's seen, again, go back, look at equities. You'll see how they tend to turn the market. After you begin to spot manipulation, things will make a lot more sense in this market. Robert, good question. You're saying, but we're looking for a second push up and didn't know it was a false breakout until it was over. Hindsight's 2020. Very good question. And that is exactly true. I'm not saying that you should have caught that move. I'm not saying that that move served a purpose for you. In fact, when we look at the different levels that we had on the way down, you're exactly right. We were looking for the second push. So because of that, we had 3 points that we were looking to trade the manipulation from. And I'll list those levels out here. One of them was 82, and that was just a clear level as you go back. 82, 83 was a very clear level. You go back, you look at your charts here. So just as Robert said, we had a first push up, and we were looking for the second push up. So one of the great parts about the strategy is that very often, if cycle is going to change, or if we have a failed push, or if we're going to have a failed push, what keeps us from essentially getting screwed on that trade, or what keeps us out of the trade? And again, we ask ourselves those two questions. What cycle are we in? So we identified cycle as having the first push up. We were expecting the second push to the upside. So that was question number one was answered. We were expecting the second push up. Number two, we identified our high probability points based on previous responses and some other correlation in the market. And the third point is we wait for the manipulation at that level, and that is the fail-safe. Waiting for the manipulation at that level is really the fail-safe. So as the market came down, and as I talked about in last night's review, this was an absolutely, let me zoom over, this was an absolutely fabulous stop-run candle. At the end of this candle, I know there was a lot of members saying, you know what, this is going to be a great trade from the first high probability point. But what we do is we wait for the confirmation at that level. And this is what we term as a confirming type entry. So in other words, after the stop run candle closes, we don't necessarily we don't take the trade at the immediate close of that point. What we do is we let the next candle prove what the first candle started to. So again, the only time candles matter are when they come into our high probability point. Now this candle, again, was a great stop run. That was a perfect first candle of the setup. However, the next candle never confirmed up, never validated the trade, and therefore it's a no trade situation. That's why the only trade opportunity really from any of those levels, again, the second point just blew right through it, never showed the manipulation. The only one that showed the stop run followed by the confirmation was at these lows. And that trade, at least for me, ended up being about, depending on where your entry was, you would have ended up with about 15, 20 pips at the best. For me, I'm not going to take profit at 20 pips, and that's why using our 3 reasons to exit a trade, once we came back into that high probability point, we showed a stop run of it against the trade that we were in. That's why myself and the other person that mentioned that trade, that's why we were exiting at that time, because when you see a stop run against the trade that you're in, it's best to take the exit at that point. So you're definitely right. In the moment, using the information to take a trade down was not what we were doing. However, more often than not, the manipulation will keep you out of a bad trade. Because remember, if their intention is not to drive the market up, then why would they create a stop run of the lows? And so again, more often than not, if they're not going to run the price in that direction, they're not going to create the stop run either. So while that information did not serve us that day, it's what gave us our bias for the following day. So good question, Robert. It's not the banks, it's the jerk-off people running the banks. Good point, Randy. Well, Mike, I wouldn't say that the euro gave us a. Oh, okay. You're talking about this? Yes, this is. Therefore, after we have a failed first push, this becomes the first push. This is why last night in the review we were expecting the second push down, which we got, and why we should be expecting the third as well. It's possible that the euro is done, but we'll discuss that a bit more in the review tonight. Alex, it's very simple. You ask you talk about how you use the Asian 25 pip box for the reversals. If the market or if my manipulation point is in that area, I just have more confidence in it. It doesn't necessarily mean that that is 100% has to be the area where we're going to see the manipulation. But when it is in that area, then I have more confidence in it. 52.23. Well, it's a great reversal point. Actually, hold on. Before I say that, I might be at the wrong. And I know the cycles kind of screw these charts up, but 52.23. Well, just as a little tidbit for anybody that's new and has never really doesn't know a whole lot about what we do, if you look at the pound and above any other point, the 20 and the 80 level have the highest probability of turning the pound. So 52.20, 53.20, 54.20, 56.80, 58.80, 62.80, whatever 80 and 20 level it is, if there's an 80 and 20 level, and if that 80 and 20 level, 80 or 20 level, coincides with anything else, and then we see the manipulation at that point, I have strong confidence that that level is going to hold. 80 and 20 are always great levels on the pound specifically. Well, let's see here. We have a low at 30. We have a low at 41 here. Actually, it's about 37. I just don't see a great level through here, guys. I mean, you know, you talk about the 20 level. I just don't see a great level through there. Yeah, so I would say not necessarily, Miles. It's just not a fabulous level if you look back at the price. The last time we were into that point. You know, guys, let's take a 2-minute break. I'll be right back. I'm just going to grab some water. We'll take a quick 2-minute break, and I will be right back. Let me write this in here. We'll run as long as we have questions. So probably, I don't know, I'd say probably run another 20. Yes, the question was, after a stop run occurs, followed by the confirmation candle, do you prefer to wait to enter your trade, or you set a pending order? Well, some use pending. I prefer to enter my trades in the market order as it pulls back. What I do is after the confirming candle, I let the third candle pull back to where a 20 pip stop would be enough to take the trade. The author of the Law of Success is Napoleon Hill. I do not stop and reverse trades, Mooney. So if I get stopped out of a trade, I get stopped out. Pivot points. Well, pivot points can be used as a confirmation, but it's the same thing. Wherever you have a massive stacking of orders, I don't care if it's fibs, pivots, general support and resistance, previous day's high and low, 200 moving average, which is very common, or whatever it is. The only reason that we look at them, and generally I have them on my chart, on the charts that I generally use for the room, the reason that I have them on there is because when those coincide with already existing high probability points, it strengthens that point because I know there will be orders, retail orders in and around that level. Where there's massive stacking of retail orders, that's where we know smart money is going to go and take the stop. So when we have a stop run of those levels and it shows some confluence with other points, then yeah, it just strengthens the trade. M, that's a good question. What sort of realistic expectations would you like people to have for trading this method? You've already mentioned typical trade target of 1-to-1. What about things like percentage winning trades, possible range of monthly returns, and pips, and most important, worst case drawdowns to expect in both pips and duration? Very good question. Not really a question that you can answer quickly, but we can go over a brief overview of that. One of the things that I would urge traders to think about is their perception of success. And a very common trait, and this is ironic how it is, but most traders who have never seen consistent success have a perception of success that is in the range of 70 to 80% success, win ratio. In other words, they have a very high expectation of what success is. Whereas the traders that are successful tend to have a lower perception of what true success is. So it's ironic how that works. You would figure successful traders tend to have a higher expectation. But most of, and this, I can only speak to the traders that I know that are doing well and successful. But the reason that is so critical to your trading is if you have the belief that success comes from winning 70-80% of the time. I talked about this in one of the articles I wrote recently. Your subconscious mind immediately knows whether something is attainable or not. Your subconscious mind, scientifically, they say, possibly hundreds of times more powerful and knowing than your conscious mind. So if you do not believe at your core or your subconscious level that something is attainable, then you'll never attain it. And therefore, that's why, if you have the belief that success comes from winning 70 to 80% of the time, it's very difficult to be successful in that situation. So the target I want people to immediately go for is I want people to go for a win-loss ratio of 50-50. And that sounds low, and it sounds low for a reason, because immediately you say to yourself, you know what, 50% sounds attainable. And that's why in that article I did the math on what 50% win-loss on a 2-to-1 risk-reward ratio is, and the amount of gains that somebody can have on a 2-to-1 risk-reward with that with a small win-loss is astonishing. It is, if that isn't somebody's level of success, then I don't think they'd ever be happy. So what that does is that immediately triggers a response within somebody's subconscious that, you know what, hey, this is attainable. And once I can get somebody to know and believe it is attainable, then they actually have a chance at success. So the traders that are doing well with this method are generally on the low side, around 45% win-loss, and on the high side, winning around 60-65% at the best. I'll tell you right now, I generally tend to average between 60 to 65%. I would much rather, and it's more profitable, to win 60% of the time with a 2-to-1 risk reward than it is to win 80% of the time with a 1-to-1 risk reward. And so the whole perception change is something that absolutely, I believe, has to happen in a trader for them to achieve success in this market. As long as somebody continues to believe that success is 70-80%, it's going to be a goal that their subconscious mind knows is extremely unlikely to achieve. So once I get somebody to do that, that's when I really see them start to jump leaps and bounds, because what that will do is that will show you that, you know what, I do only need 2 or 3 trades per week. I don't have to take 10 trades per week to be successful. What I have to do is I have to be somebody that is extremely disciplined and patient with what I look for. I'm going to look for only trades in the direction of the cycle, only trades at high probability points, and then only take those trades once I see very clear manipulation. And if I don't see it, I'm not going to take it. Once you get to that point, and in your mind, okay, all I have to do is hit 50-50. Once I hit 50-50 to 2-to-1, anything beyond that is essentially a bonus, because one of the better traders that I have ever known, as far as somebody that is a great trader, and you guys probably have known him as well, or have heard of him. Everybody here's heard of Forex Diamonds, or not Forex Diamonds, Forex Peace Army. Well, Forex Diamonds was the room that essentially was owned by Forex Peace Army. Well, there's a trader called Sir Pips, or Tim Swanson, in that room, and this guy was extremely intelligent. He's a nuclear engineer for the Navy. He works on subs. I mean, one of the smartest guys I know, and one of the better traders that I know as well. And this guy never won over 50% of the time, but his risk reward was on average 3 or 4 to 1. And that common trait, there's common denominators among traders that are successful. One of those common denominators that is prolific in almost every single profitable trader is that they maintain a high risk reward. It's not that they have a high win-loss, it's that they have a high risk reward. So in terms of pips, you got to figure if you're risking 20 to gain 40, that's a measure of where's your risk reward, how many trades are you taking per month, and really pips don't matter. It's a percentage gain or loss that actually matters. You can make pips and lose money. If you change your percentage risk, you can make pips and lose money. So again, it's percentage risk or loss, or gain or loss that actually matters. As far as drawdowns are concerned, there's times where you will go through losing multiple trades in a row, and that goes with any strategy, and any type of scalping, swing trading, day trading, no matter what it is. You will go through a series of losing trades, and that's why risk reward is so critically important to your psyche, because you know that one winning trade makes up for 2 losing trades. And that's why if you did lose 4 or 5 trades in a row, you know that it's going to take 2 or 3 trades to get you in profit, whereas if you didn't maintain that positive risk reward, you'd have to win at least the same amount that you lost. It's a big psychological pull, and it makes a huge difference. Well, Haran, the one thing I'll say, you're asking me about high frequency trading. This is a story that I've told in the room many times. I'll tell it to you guys again. When Alpari US first opened in the US for US traders, what I would do is I would put MB Trading's price, because I traded through MB, I'd put MB's price right next to Alpari's price. And their price was slow, but their execution was instant. And so what I would do is I would just scalp a pip or two here and there as their price was off. And that's called arbitrage trading, not quite the same thing. But if you can find a broker like that where their price is slow, but their execution is instant, you can make a killing in a high volatility market. But again, we're looking at something that's sustainable, and that type of trading is not sustainable because eventually the brokers figure it out. It only took a week for them to shut my account down. They put 10-second delays on all my orders, and that shut me down. In that 1 week, though, I took 22,000 from them. So they will shut you down. It's just a matter of time, and that's why I recommend somebody actually learns how to trade rather than finding little, what I term as gimmicks. Now, on the other hand, anybody feel free to tell me if there's a broker like that, because I will exploit that gimmick all day long if it is available. So I'm not saying not to if you see it, but it's not sustainable is what I'm getting at. Generally, I trade 2 currency pairs, Matt. I trade the euro and I trade the pound. If I'm going to trade a yen cross, it's going to be the euro yen. And I do like some of the exotic crosses. The euro Swiss is getting back to moving a little bit. But your pound Swiss, pound Aussie, euro CAD, some of the pairs that make larger moves, they have very good, essentially very good stop runs from time to time, and that's what I look to trade. Forex, I appreciate the kind words. That was nice of you. Glad it's helping you. MA, same thing. I appreciate it. Robert, when this move is happening, in other words, on the euro, your question was, you're saying the failed push reverse, there was no entry to the downside. Because we're in expectation of the second push up, we will not look to trade that first push down. So this first push down will be a move that we do not catch. Yes, that is exactly what I was saying. The question in regards to 80 and 20, why 80 and 20? I don't know. And that is something. Go back, you look at your charts on the pound, you find 80 and 20 levels. And just look at it over the course of, over the course of however long you're looking at your charts. Find 80 and 20, and look at the turning points in the market, short-term swing points. You'll find that the pound frequently turns at 80 and 20. Why it does? That's a good question. It's not really. I've never heard a great. I've heard a few explanations. Never really heard a great explanation as to why. Forex, the thing that's confusing me is the entry point is the entry at the top bottom. What I wait for, Andy, is the 3 candle confirming entry to play out before taking the entry. Because until you have that manipulation, or until the market has confirmed that it's a stop run, then you have no reason to believe it's a stop run. So until that is completed, I don't take the entry. Bob, I use MT4 as the charting platform. I do not use MT4 to place trades off of. I use MB Trading. MB Trading is a broker I've used for 5+ years. I broke away from them for a while because they had extremely high commission. Now they have trading without commission now. So they're a good broker. They've never done me wrong. They're not perfect, But you know, the biggest thing I tell people to do is to stick with a broker that's been around for a while. Apara US was always good to me. They are a bucket shop broker, but they were always good to me. So I don't technically recommend brokers, but I will let you guys know who I've used and who's always been good to me, and those two have been good to me. Duke was always good to me. You know, and those are all decent brokers. Ray's question, do you ever see a new cycle starting on Friday? Well, I don't think days really matter on when you have the start of the cycle. It has happened before, definitely. But as far as the probability as to when it will or won't, I would say that you know, as far as having that probability, I don't necessarily say that it's more likely or it's less likely. Ron's question, how'd you end up becoming a full-time trader? Did you have a day job before? Yes, I worked beforehand, and I always recommend that traders do continue to work as they learn to trade, because it takes a lot of the stress of learning to trade off. You know, guys, I learned the same way that you did. I learned by buying every piece of crap out there and losing a lot of money. I can't tell you how many $5,000 accounts that I blew. I can't tell you how many times I took a $2,000 account to $10,000 only to wipe it out in a matter of hours. You know, and I have the same background as everybody else in this room. There is no difference. Where the difference was, and I still remember the exact moment when I took a loss on the pound, and I remember just being at my lowest point and saying, you know what, damn it all, I don't care what it takes, I don't care what I have to give up, this will be my job, period. And I still remember exactly what I was wearing. I remember every single thing about that moment. And for me, that was kind of a game changer. And it's, you know, it sounds corny, it sounds cheesy, but that really, I think, was a turning point for me. And once I really started to understand, you know, starting with the stop run and starting with just spotting manipulation and starting to realize that every mainstream BS strategy out there is exactly contrary to how the banks have to trade. And once I started putting all the different things in and around the stop run, the you know, the picture became clearer and clearer. And once really I got to be a break-even trader, once somebody's a break-even trader, they're so unbelievably close to success. And really, once I got to that point, it wasn't long before I was doing well. But it took another year after being profitable to have a large enough account to deal with. And you know, for a lot of traders, it'll take longer than that too. You know, and my road to success was not easy. You know, I'd say it at least took, including that year where I was building up my account, at least 4.5 years. You know, but unfortunately, I never had. I wish if I had something like what we offer, I know it would have been faster. But a lot of this came from, you know, all of what I do now comes from a very small seed, and that very small seed is a stop run. The base formulation of manipulation, and that seed became a much larger idea and strategy around it. Hussein, you're asking, could you share with us your monthly performance over the last 12 months? There's a reason Chad and I don't share performance, and quite frankly, for anybody that's not familiar with this room, for 2 years, every single one of my trades was live in front of the room. Has nothing to do with being profitable or not being profitable, because if you can be profitable in front of a room calling every one of your trades in front of the room, then you can be profitable anywhere, because it's a very nerve-wracking feeling when you know 100 or 150 people are taking your trade and you're responsible essentially for their account, or you have some responsibility for their account. So one of the things that I learned during that time is that traders would watch me trade profitably month after month, and within every month or excuse me, within every year, I always tend to have one losing month, and that's been the average for the last 4 years. But one of the things I learned is that even though they would watch me every one of my trades live, the amount of traders that excuse me, the amount of traders that would actually succeed was much lower, and the reason was they became extremely self-reliant on Chatter Eye. So when we talk about trade for trade, somebody looking at trades and trying to duplicate it, the live room format, or the understanding each individual trade Chatter Eye takes, it tends to create little Chads or little Sterlings, and that's not what we want. We want traders to develop into their own way of trading. Like, for example, one of our longtime members, Daniel, which I don't know if he's here or not, but he essentially follows the strategy and does things just with his little tweak to it. And that is a very common trait of anybody that is successful, is they have their own little twist to the basic foundation. So we find that when we, especially with the live room format, people didn't have to become their own, essentially be their own trading method. They would try to replicate everything we did exactly. We found it didn't have the same success rate. Although they would watch us trade profitably, it didn't seem to effectively train traders as well, which is why we steer away from that more now. Miles, good comment. Miles is saying, I lost emotional subconscious thing. He says, I've always lost money until January this year, when in the second half I won every single trade. I could see all the trades. I took them. I was relaxed, and they all won. And then at the end of the month, I suddenly realized that I could make serious money with this, and that freaked me out, because the only way I know to make money is to slog away and work like a dog for all hours. And to just click buttons to buy and sell and then close seems almost like cheating somehow. So now I'm working on myself with regard to this emotional subconscious stuff. So I agree, it is partly about technique to get the trades and then deal with this emotional subconscious stuff. That's exactly right. And that's why when you sent me that email, Miles, one of the things that I told you was be careful. And the reason I said that is because we've seen a lot of traders that follow that same path. The first time somebody sees success, it is a very emotional response. Maybe they've been trading for a year, 2 years, 4 years, they've failed for all those years, then they come to us, they learn the strategy, they start to apply it, and they start to succeed. And the first thing I tell them is danger Will Robinson, because that is one of the more dangerous spots to be in, because it's a very emotional response, and some of the worst trades will come after your best times trading. And that's why when I looked at your track record specifically, and I see 15, 20 winning trades in a row or whatever it was, one of my, I guarantee in that email, without even knowing exactly what I wrote, I'm sure, as I expounded on this last time, and I tell everybody this, your first swing at success, you have to be extremely careful, because, like you said, the emotional subconscious response is going to be very strong, and it's much stronger than a lot of people realize. Randy, the way when you're talking about what I mentioned about the arbitrage trading, the reason that you will not find it working right now and you have to have the volatility increase is because when I did this, or one of the times I did it, it was during 2009, when, and for anybody that was not around during 2009, just a quick overview. If we look at a daily chart here of the pound, let's look at a daily chart of the pound. I'll bring you back to the craziest day in the market in a long time. But if we go all the way back to 2009, we start to look at what the days I was trading back then. You look at this day right here, and this was October 24th of 2000 and let's see here. Yeah, 2008 actually, excuse me. And coming into 2009, the high on this was 62.97 or 6,300, and the low was 52.60. So 1,050 pip day here on the pound. You look at even these small candles here, even this tiny candle right here. The high on that was 73.81. The low was 72.20. That's 160 pips on that little tiny candle. So we were dealing with a much different market. And for anybody that wasn't around during that time, you can't even fathom what the volatility was like. It was absolutely insane during that time. So if the price was delayed from true market by more than a few seconds at the beginning of the London Open, you'd have instant 10 pip spikes back and forth, back and forth, back and forth. And those spikes you could trade. Nowadays, it's extremely difficult to do that because you just don't have the volatility. Ivan, you're going to need to send us an email. So just send it to daytradingforexlive@gmail.com, and I will get that out to you. Let me know what you need, and that way I can respond to it. Otherwise, I'm going to forget. Jim, you're asking, when are you confirming the 3-candle setup? Are you watching on a 15-minute chart? Yes, the 15-minute chart is where I take the entries from, where we take the entries from. Why are they called bucket shops? Well, it's the name that applies to them. It goes back to the the olden days when the myth of them putting buckets over their head to hear orders coming in. So it's a name that goes back a long ways. But essentially, it implies, or the application nowadays is that a bucket shop is going to be somebody that holds your order in-house, and therefore when you sell, they buy it to you, and when you buy, they sell it. They sell it to you. Yeah, when you buy, they sell it to you, and when you sell, they buy it from you. Michael, no, I do not hold positions over the weekend. Awanda is a decent broker. Lucky back 4 or 5 years ago when spike trading was brand new, I absolutely made a killing with Awanda. And some people literally retired off of 6 months of spike trading with Awanda. Doesn't work anymore, but in the good old heydays of trading before we screwed up spike trading for everybody now, it was a very good broker for that. Nowadays, they're a decent broker. They've been around for a long time. Your money's safe. So my biggest concern always is preservation of capital. It's that way in trading, and it's that way when I select a broker. And that broker's been around for a long time. They have a big market cap, and therefore I feel safe with them. So I would feel safe with them. I personally do not have an open live account with them right now. It's been probably 4 years, I'd say 3-4 years. Coming up on 4 years ago is when it really started to come together, the manipulation strategy. Like I said, it started from a basic seed of the stop run and developed over the course of the years. While the base of the strategy remains the same, I'm sure there's things that will come and go to either help, that will help and be added in or taken out. Alonzo asks, can you show us an example of a stop run? Well, we'll use a trade that we actually took. And here was one 2 days ago where we had, this is a set of reversal legs. If you think about it, guys, when we look at what a stop run is, and I'll just draw a few things out here so you can get a good idea of what a stop run truly is, and I'll change the colors of these here in a minute. But any candle formation that I'm going to draw right here is going to show you the exact same thing. The basic principle of a stop run is that you're seeing a level broken, and then you're seeing that level immediately, the market immediately reject back up above or below that level. So when you see the market break down below a high probability point that you were expecting, and then the market stays below that high probability point, that's not a stop run. It has to, and I'll change this around here. Okay, so let's just assume that this line I'm going to draw right here, and I'm going to change the color of this so you guys can see it a bit better. I'm going to change the color and I'm going to thicken it up a bit. Let's say that this black line was a high probability point, and let's assume that the market was coming down into this level, and then we saw a set of reversal legs at this point. Notice how the market breaks below that level and then immediately gets rejected back up above it. That is a set of reversal legs showing you it's a stop run. But think about this for a second. If you combine those two candles, what would you have? Well, you'd have a candle that looks very similar to this right here. And I'll draw this just so it looks the same. But if you combine those two candles, the candle that it would make would essentially look like this. Therefore, a set of reversal legs is the same thing as a single candle stop run pen. It's just another way of seeing it. Now, this is typically what's termed as a morning star candle pattern. If you guys don't understand that, that is nothing specific to chat or I. Very simply, it is just a way of identifying a stop run. And the basic foundation of a stop run is that in the case of a long setup, it's breaking below the high probability point that we expect and getting rejected back up above it. So as we go out to the daily chart and we look at these highs here, this is a very clear single candle pen of the highs. We saw a very clear high be established. The market then comes back, takes out that high with a single candle stop run pen, and that's what starts the move. More often than not, a large move will start and end with some type of manipulation or stop run. That's why it's such a powerful tool and why we put so much focus on it. Because if you don't, then you're just missing out on a massive chunk of information. The banks are essentially telling you, hey, I just took the orders here because I'm going to run the price the other way. So from my perspective, there's only two options. Either you understand how to trade the manipulation, or you become the victim of the manipulation. And there are only two options to that. Again, you're either going to somebody either understands how to trade the bank cycle and the manipulation, or they're going to become the victim of it at some point. That's why so many breakout traders come to us and they go, "Oh my God, I see that I was doing exactly the opposite of what the banks are doing." I'm glad that the site helped. We get that a lot. I mean, that's and quite frankly, that's probably one of the more rewarding things. People come to us and say, like you just said, I've been studying the market I'm 24. I've been studying the market for 5 years, but your website made me realize the truth. That it's quite a rewarding thing to see somebody send us an email that's been failing for 3 or 4 years. And again, we are not an easy way out. There is no easy way to succeed in this market. What we do takes work, it takes time, and it will not, if somebody joins us, they're not going to succeed tomorrow. It's not the way it works. But with that being said, it's quite rewarding to see somebody, fail for years or whatever they had prior to coming to us, and then finally seeing some success. That's quite it's rewarding on both ends. Well, the good thing about what we do, Brian, is that it's not during a high volatility time in the market. So if your broker is consistently slipping you and you're trying to take an entry during these normal market conditions, which is what all our trades are, then you're very simply the broker's the problem. It's an easy fix. You change brokers. Welcome to the service, Andy. Just saw you joined. I'll get your account open here shortly as soon as the room's closed. Okay, let's see what other questions we have here. No problem, Lucky. Glad it helps. What time frame do you use to spot the 3 cycles? I see as many as 4 or 5 on different time frames. There may be 2 or 3 on one time frame and 4 or 5 on a smaller time frame. Well, number one, you have to understand the rules that go with it. Trying to trade the strategy without understanding the rules is it's kind of, I always worry that sometimes maybe we give away too much on the front end of the site, because I feel like traders take a portion of it and they go off half-cocked, if you will. In other words, that's a very dangerous position to be in because they know enough to be dangerous. So number one, you have to really understand the cycles. Otherwise, if you're leaving a few things out, it can be kind of dangerous. But the gist of what we look for is really only on 2 charts. The traditional way of trading. Others that trade this method do it on longer cycles and longer manipulation periods. That's the way they do it. Personally, the way we teach it is with 2 different time frames. You can look at the hourly to identify the weekly cycle, because the weekly cycle is over the course of 3 or 4 days. Once we've identified the cycle, everything else comes from the 15-minute chart. Kathleen, I'm glad that the website's helped. Glad you like it. Man, no problem. Happy to run this from time to time. I'm sorry it's taken so long. We've been asked for probably a year and a half to open up the room for a day, and while this may not be the traditional room necessarily, I mean, it's close to the way we usually run it. Number one, we go over what happened the previous day. If there's a trade setting up, we'll talk about it and talk about what's got to happen for us to get a trade, and then we start to go into question and answer. So it's pretty similar to the way we generally run it. Is just today we don't have a whole lot to talk about as far as live market, because the market is so far outside of the norm. Robin, just I guess I'll talk about him now that he's left the room. Robin has been a big help to us. Robin provides a perspective that I can't provide, because quite frankly, what we offer is not going to help everybody. If, like I said before, if somebody's not willing to work, you might as well just not even sign up. So if you think trading's easy, if you think it happens overnight, it's pretty simple. We're definitely not the people for you. But if somebody's willing to put in the work, one of the things that Chad and I always say is we're willing to put in as much work into you as you're willing to put into yourself. And what Robin does, he provides a different perspective. Because he is a member, he provides a perspective from a member's view on whether it would actually help somebody or not. So Robin, Chad and I are quite thankful to Robin. He's taken quite a load off us as far as answering some of those emails and providing a much better perspective. Oh, yeah, I got you. Yep. Yeah, you're exactly right. During that time, slippage was definitely a problem. But generally, if you set it to about a 3-pip deviation, you'd be all right. The time frame I take my trades off of is a 15-minute chart. Understand, however, and don't, this is a very important part. If the candle pattern or chart pattern means absolutely nothing to us unless it's in the direction of the cycle at a high probability point during the times we look to trade and showing us the manipulation or stop run of that level. You're going to see 1,000 stop run candles, 1,000 sets of railroad tracks through the course of a week, maybe not 1,000, but you guys get my point. It only matters to us at our very specific points. Valerie, the times that these boxes are set, and you guys can, these indicators are very common. There's an indicator that Chad's used for years called I sessions, and it's a very common indicator that you can adjust your charts with. Maybe it doesn't have as much functionality, but actually this might even be I sessions on this computer, quite frankly. But the times, and anybody can feel free to write this down. My Asian block goes from 5 p.m. Eastern to 2 a.m. Eastern. It ends at 2 a.m. because that's when Europe opens up. So this space in between the Asian block and the New York block is from 2 a.m. to 8 a.m. And then the New York block runs from 8 a.m. to 11 a.m. Robert, in relation to the moving averages, when I identify a high probability point, and I'll go back to, let's see here. Okay, well, here's a good example, and I'm not 100% sure, but this is in April. I'm just scrolling through the charts, but if we move down, you can see that this was a decent high probability point. And this is outside of our trading time, so I'm not saying it's a viable trade, but it illustrates the point. Notice how this level had a lot of response to it, responding as both a support and resistance point. You can fully expect short-term orders to be sitting in and around that level. And then you notice how the market comes down and it creates a stop run on this point, and I'll zoom in a bit better so you guys can see it. But the market then comes down and creates a stop run on this very clear, well-established low. No doubt there's orders sitting below that point. But you also know that's 200 EMA was right there as well. The 200 EMA, when I see a stop run of the 200 EMA, in other words, when the 200 EMA is lining up right with the high probability point I'm looking for, it very simply adds to my confidence in that level. The 200 EMA in and of itself will never be a high probability point to trade from. But when it lines up with an already existing high probability level, it adds to the confidence. Very good point, Jim. Very good point. Jim said winning combination consists of discipline, low risk, high reward. High probability trade, more discipline. Very, very good way of saying that. Stan, the way people trade that have a schedule like yours, number one, everything starts from the same point. In other words, no matter how somebody's going to trade, they all start from learning the same foundation. So somebody like you would start by learning the strategy in its entirety. And what's great about what we do is everything we do is recorded. The room sessions are recorded. If you're not able to attend, again, the room sessions are recorded. And the daily market reviews are a video. Obviously, those are recorded. So somebody in your situation would start by learning like everybody else. Where you would differ and where the people that have your type of schedule differ is that they have to find another way to essentially trade because they're gone during the hours that are the viable options. So, this is a work day and you're looking at the computer at 11:20, so I would assume you have some type of access to the computer. What's good about our strategies and what we do is that we do not have to sit there and stare at the market. At midnight, generally each day when I put out the review, I know the direction I'm looking for and the high probability points that I'm looking for. So a quick glance at the market every now and then is the way to do it. I'll tell you, quite frankly, 30 to 50% of my trades come from trades off of my phone. And the reason being is if I have to leave the house at 9, because of what we do, and because of what we look for is so specific, if the market's not in and around the level we're looking for, then we don't look to trade it. So it's a pretty, it's pretty straightforward in that sense. Others trade 1 hour stop runs, and still others trade a little longer charts. How somebody does it is going to be, specific to them. But if you're watching a seminar, I would assume you have, or watching a live room, I'd assume you have some time to maybe glance at your phone once or twice, every hour or two, and that is generally enough. Especially given the fact that you're going to know what high probability point you're going to look to trade from. That's a good point, Patrick. Something I always recommend for any of the members. I always recommend you do your own analysis before you watch the daily market review, because for those of you that aren't familiar with the daily market review, and for the members that are just getting acquainted with it, in the daily market review, I tell you the direction I expect for the day based on the cycle and the exact high probability points that I'm going to look to trade from. And the best thing you can do is do your own review and then look at my review. Oh, Glenn, stay away from the radiation, man. Make me go on my conspiracy theory rant here. All right, we're going to be wrapping it up here shortly, guys. We're coming up on 2.5 hours, so it's ran about 30 minutes or 45 minutes longer than usual, which is good. I'm glad we answered so many questions. But we'll be wrapping it up here shortly. Ross, the answer to the question is no. That would not be a valid entry, unless that point is. Let me rephrase it this way. Some traders are extremely aggressive, and other traders are very conservative. I tend to fall on the more conservative side of things. So if a level, unless I'm seeing the break through that level and then rejection back either up above or below the point, depending on which way it's happening, the trade is not viable. And trade is not a viable option. And for me, unless a moving average coincides with a other high probability point, then I would not be using that as a high probability point. Well, Stan, then one of the things that I would say is, if somebody doesn't have the ability to even glance at their phone once an hour, or once, every now and then during that 3-hour 8 to 11 period, then it's going to be very difficult. Number two, the second option is getting up and trading the London session. I did it for 3 years. It can be done. It's a matter of how bad somebody wants it. But I also was single, not married, and so that does have an impact. Other people are much busier than I was. But I have known married guys that have a couple kids that have done the same thing. So it can be done. It's just a matter of how bad somebody wants it. All right, guys. Well, I got to get running. I have a cross-country flight here planned. By cross-country, I mean not like cross-country, but a little closer to the UP. So I got to get moving. Maybe I'll post some pictures to the site here. I always say I'm going to do that, and I never. Every time I go, I never post any pictures. I need to do that. We have quite a bit of snow right now. You get up, around 1,000, 2,000 feet, and it is absolutely beautiful looking out over the snow. Everything is caked with that blanket. Bob, we'll welcome you to the site. Look forward to seeing you. Well, I didn't avoid the question intentionally. I've told people this many times before. My one of the family businesses was well, a couple of family businesses. Fortunately, I come from a family that never worked for the man, so I've always had that mentality of, you know, I'm going to eventually do something on my own one day. So one of the family businesses was a machine shop. We also own 100 plus acres of blueberries. And my dad was a drywaller, and I did drywall for a living before I started to trade. But he also, also worked in the machine shop as well. So, for me, the whole idea of being self-employed was something that, fortunately, through my life, was something that was always ingrained in me. Now, it wasn't necessarily that I was going to follow in one of the family businesses, which, quite frankly, I would love to own a blueberry farm even right now. I would love to work on a farm, because as a trader, you have to have something else to do. That's why I always say, have a hobby. My dream in life was always to fly an airplane. So that's been my hobby. That's what I love to do. And you have to have something outside of trading. So I would, quite frankly, when coming back to looking at a job, I would love to actually own a farm and work on a farm in the summer, as far as having something else to do. Because, again, as a trader, if you're sitting there at your desk, you're doing nothing all day, that's a very unhealthy lifestyle. And a lot of people think that, once I become a trader, I'm just going to sit back and relax all day. It never works that way. I've never met a trader who has become successful and absolutely does nothing. It very simply doesn't work that way, because you get bored. Never seen snow up close. I love that answer. Michigan. Quite frankly, guys, I mean, I loved it. If my dad needed help, I would gladly go do that. I think that it's very important for traders to have other things that they do. It doesn't, it means that, obviously, if you're trading full time, well, you're full time, meaning you need to be there during your trading hours. That should be the most important thing to you. But you have to have something outside of that. That's where the site comes into play, because the site for me is a great, encouragement, if you will. It's an additional part of trading, where trading doesn't necessarily hold the same spark for me it does for a lot of people. And after you're successful, it becomes a job, and it becomes a lot of redundancy and a lot of routine. So you kind of lose that, that spark of, you just don't have the same spark you did in the beginning. And I think that's totally natural, and that's probably the way it should be. I don't, my heartbeat doesn't come up when I get stopped out or when I hit a take profit. It's just not the same anymore. And in order to keep the desire alive, the site has done a lot for, I think, both Chad and I, because we see, helping somebody else and seeing somebody else progress is something that is very, it's encouraging, and quite frankly, it's probably one of the more rewarding things when it comes to trading. Here's the trouble with where we're at right now, and one could say, this, number one, this wasn't a high probability point that I was looking for, but you did have a high that was established at the beginning of New York, and you're somewhat creating a stop run on that level. Now, we have not confirmed down as of yet, but to me, it's number one, it's outside of the trading times. Number two, it's a stop run by only a pip or two. We like to see a stop run breaking a level by 3, 4, 5 pips. So the fact that this is only breaking it by 1.2 pips, or actually 1.1 pips, not quite a stop run. And, you put all of those factors together, and it basically screams no trade for me on that situation with the pound at least. That's a good point, Patrick. Patrick says, does counting your gold and silver bars count as a hobby? Well, I have a lot more silver than I do gold, but that does count as a pastime. Sometimes I like to count my bullets as well. That's actually been my pastime as of late. Really stocked up. But in all seriousness, guys, I'll let you guys know when I'm buying silver again. I've said for the last 3 to 4 months, I think we're going to see a big push down. I think, you know, if they are going to run the market up, what are they going to do? Well, what do we look for in the Forex market? We look for them to create a false push down to induce selling pressure, to buy into the selling pressure. We have yet to see a panic sell. I expect a panic sell before they drive the market up. Maybe that's wishful thinking right now, but it's getting closer and closer. We're breaking below some pretty key levels. No, I mean lead bullets coated with copper. That's the bullet that I mean. All right, guys, that's going to wrap it up for the room today here. I was happy to see everybody that's new. I hope you guys had a good time. And I got to get running. Thanks, Tom. Appreciate it. Will do. Hopefully the wind stays down. So, anyways, I will see you guys for the daily market review tonight. Everybody have a great morning or great evening wherever you're at.